Rob, you've recently co authored a piece titled Is Diversification Dead? Noting that the past decade's returns for diversified portfolios have disappointed relative to mainstream US stocks and bonds. Can I ask you to summarize your findings, including answering the question, is diversification dead?
Is diversification dead? No, diversification is not dead, but diversification can be a regret maximizing strategy. During a roaring bull market for mainstream stocks, your classic diversified balanced portfolio, typically 60% stocks, 40% bonds, has performed brilliantly, and alternative asset classes can't keep pace. We went back over the last almost 50 years to ask the question, what good is diversification? Back in 1974, the stock market was low and bond yields were high. Today, the stock market is high and bond yields are low. So it's been a great 48 years for a classic 60-40 balanced portfolio. It would be very dangerous to assume that the 2020s will look like a continuation of the last decade for the very simple reason that yields tumbled and stock valuation multiples soared to create the great returns of the 2010s. And if you expect that again in the 2020s, you're expecting valuation multiples to soar to new highs, new all-time highs, and yields to fall from already low levels.
Chris, what does Research Affiliates analysis suggest are likely to be the best returning markets over the next 5 to 10 years?
Looking forward from today's elevated prices, we forecast a return for the U.S. equity market of 2% over the coming decade. Long treasuries with a trailing 10-year return of 8% for the past decade are now priced at 0 to negative real yields, which is about what you can expect they will provide over the next decade. Cheaper assets, notably including emerging market equities, which have seen trailing 10-year annualized returns of a mere 5%, offer a more attractive return forecast of 8% annualized over the coming decade. Putting together a portfolio of domestic stocks and bonds, we forecast nominal returns of approximately 2% per annum over the coming decade. On the other hand, an efficient frontier portfolio with similar risk as US 60-40 is priced to deliver nominal returns of 5% over the coming decade. How? Well, this efficient portfolio has outsized exposures to much more cheaply priced diversifiers, inflation-sensitive assets, and non-US markets.
Rob, can you talk about the outlook for value-oriented equity strategies at this point in the cycle?
If you use the classic definition of value, price to book value, the performance of value relative to growth was terrific for the 43 years from 1963 to 2007. And then subsequently has underperformed. That's a 13 and a half year dry spell. 13 and a half years from the last peak to the trough last August. We find that value underperformed not because the value companies were doing badly in their underlying business, but they weren't doing worse than historic norms. We come to the conclusion that over the coming 5 years, we're expecting potentially double-digit excess returns for value relative to growth. Now, it's for this reason that all assets strategies have traded into all-time high exposure to the PIMCO RAE strategies in the last quarter, mostly outside the US because US stocks are expensive and non-US stocks aren't. So these strategies are currently positioned to further amplify any rebound in value in the years ahead. And we do think that that rebound started last September and is likely to continue for several years.